Well, good morning, folks. My name is John Needham. I'll be your host for this gold video from the Danielcode of the 19th of March. As usual, the charts that will accompany this commentary are available at the link at the right-hand side of this video on YouTube, or at the Danielcode, www.thedanielcode.com. Well, what a difference a day makes. Yesterday, Wednesday, we had the results of the Fed Open Market Committee, the FOMC meeting that I warned you about in the previous video, the equity video that I posted 2 days ago. And the Fed did what they've been promising to do, and it seemed to take the markets hugely by surprise, and that is that Bernanke has now committed the US Fed to a policy of quantitative easing. This is exactly what Japan did 12-14 years ago to try and overcome the crash in their property bubble, which really started the whole of the problems in Japan. And it's a expression that means flooding the economy, forcing liquidity down the throat of the economy. How it basically works is that you have the US Treasury selling T-bonds, US bonds of various time periods, to raise money to meet funding requirements of the US government. And now you have the US Fed, another instrument of the US government, although technically it's independent, expanding its balance sheet to buy massive amounts of T-bonds. And last night Bernanke's announcement was that they would commit at least $300 billion. What then is happening? You've got one arm of the government selling debt, and you've got another arm of the government buying debt. Why are they doing that? Why is it necessary? Well, obviously the levels at which they can sell the debt to raise capital are not sufficient for their funding requirements. So the way that you force feed the goose, if you like, is that you have another agency buying these instruments, and that means that it gives them some higher rate of liquidation of the bonds. There's more money going into the economy, the bond market. It's a pretty desperate move. It has been well telegraphed. I'm not quite sure why it took the market by surprise, but the market certainly reacted as if it had had a heart attack. Have a look at the chart for US T-bonds. It's the biggest bar I can find on the chart. I mean, I've only gone back 2 or 3 years. There may be bigger bars, but I doubt it. And I think it was almost 9 handles, the 30-year T-bond bar. So that really did take the bond market by surprise. Gold had a sensationally wild night, down and up and down and up again. Silver was much more rational, as you'll see when we get to the charts, and the Huey, of course, has had a very, very big day up. How that all sorts out, we won't know for the next few days. These news item type news spikes are not of themselves telling, but we can say that there's plenty of panic amongst gold bulls, and if gold is ever going to do what its proponents say it's going to do, and that is to go ballistic on a moonshot and to be the last safe haven of wealth, well, now's the time for it to do it. I don't think it's going to do it, but what would I know? Nobody knows the future. We just need to, as traders, take the signals as they come, and that keeps us close to the market and on the safe side of the trade. We've got a number of charts to look at today. They were done in 2 lots. Some of them were done 2 days ago, and I updated the last 2 charts today to reflect Wednesday's price action. So we'll just move through those quite quickly. The first chart, chart number 1, just showing you the recent T3 signals that this market's been generating. It's been quite spectacular as a trading market. It's been throwing off very clear definitive signals for us, and you can see that 5 of the last 6 TO3 signals have had follow through, been very valuable trades. I just want to draw your attention to the grey bar in the middle of chart number 1. Next to it I've got a notation, TO3 buy signal elected and failed. What happens with these outside days is that the market starts to make its turn in response to the T3 signal because it knows that it's at a price support level. and the market understands that its time cycle, its minor cycles, we're only talking about very minor cycles for these T3 signals, that cycle has expired, so the market attempts to make its turn, and if the market remains in equilibrium, it will make that turn for 1, 3, 6 or 7 days it normally does. What happens then sometimes is that a new force comes into the market, and that new force takes the market out of equilibrium and drives the market back nearly always along its original trend. So that's what happened in this case. A new force came into the market, started to make its turn for the buy signal, then turned and dived down. The failure point for these TO3 signals is the other end of the setup bar. So as that bar got to the point where it would make an outside bar, that's your stop and reverse point. Now don't be frightened of that. There was another $4,000 a contract in that trade at the stop and reverse. And TO3 and outside days are trend predictors in all markets except equities. You can almost make a system to trade nothing but outside days. You will something approaching 87 to 89% that you'll at least get any losses on the one side of the trade back. It's a very high probability trade. Chart number 2. I've just set out here in a series of charts for you a closer look at the entry signal. Some of you are having trouble with the entry signals. You'll see here we're examining the entry on March the 4th. There's a red rectangle around the whole of the TO3 day, and the blue rectangle around that little bar there shows the first cross on the stochastic. Now it's the first cross on the stochastic that we're interested in. Very simply, we buy the high of that. You can put your stop underneath that minor setup bar, but it's a much more reliable place to put it under the swing low or above the swing high, as the case may be. You'll see there that there's also a blue oval on the stochastic on that chart, which shows you as the stochastic gets to the overbought position, that's where you should logically start trying to take your profits or tighten up your stops very dramatically. Next chart, chart number 3, shows you the entry on March the 9th. You'll see there that the small bar in the blue rectangle, which was our short-term setup bar, had already passed before the TO3 signal came, which means that the 240-minute entry is not available to us. You could have sold that on limit anywhere inside that setup bar. A better solution is to then go to the 720-minute entry or the daily entry. You'll see again there on the stochastic I put the blue oval just to highlight on the fast stochastic when the market gets oversold and you're on a sell, that's the time to start tightening up your stops or take profits. Chart number 4 is exactly the same thing. It moves on to the next entry on March the 11th, which was a buy signal in Huey, and you'll remember I've said to you on many occasions these markets are so highly correlated that if a T3 signal is elected in one of them, it will almost certainly be elected in the others, and that gives us a D2 or derived data type entry. So if we have a buy signal on the Huey, we can execute it in gold if it's elected. Chart number 5 just shows you where that signal went. Where was the logical place for it to go? Well, straight to the black line on the minor swing, 939.50. That's exactly where it went. So that was a place also that you'd be tightening up your stops. You can see the stochastic was overbought. We're at black line number for the Danielcode. That's the time to tighten your stops and invite the market to stop you out. Don't be frightened to ask, but invite the market to stop you out. I like to say, well, the market's either got to keep going or it's got to give me my profits, one of the two. That, of course, is a comment for a short-term trader. Look at chart number 6 now. We had a TO3 sell signal there, and that chart actually ends on March the 16th. I'm sorry. There are 2 more days of data to come after that, but just have a look when that TO3 signal was made. And you remember I've talked to you before about qualifying these trades. If you have a look from there moving to chart 7, which is the same chart, but it's gone from a 720-minute chart to a daily chart. The daily stochastics were both pointing upwards. The mouth of the stochastic was opening. It was like an angry tiger. It was roaring, or a crocodile if you prefer, big snapping jaws. That means momentum is accelerating. So we had a TO3 sell signal into accelerating momentum on the stochastic, which tells us it's unlikely to be more than a short-term trade. Doesn't mean you don't take it, but you have a high awareness that it's probably a short-term trade. And in fact, if you look at chart 8, that's what happened yesterday. when the Fed came out with its announcement. It truly shocked the market, and we had all sorts of drama with an outside day. Big move. Be interesting now to see. The market will have to reform after that degree of emotion. Chart 9 is the silver chart, shows you exactly the same thing, Wednesday's price action, but as you can see, silver behaved far more rationally. It went almost perfectly to its Danielcode number, did a reversal there, not unexpected given the state of the stochastic. I hope that's brought you up to date with the silver charts, and you can see much more information at the Danielcode website.
The music died. I started singing bye bye Miss American Pie. Drove my Chevy to the levee, but the levee was dry. Them good old boys were drinking whiskey and rye and singing, this'll be the day that I die. This'll be the day that I die.